Hi, I'm Kenny Klaus, and this is State 48 Homeowner.
Hey everybody, and welcome to the State 48 Homeowner Podcast. Today we've got a topic that a lot of people have asked about, especially when they're thinking about buying a home, buying a car, those kinds of things. And it comes down to the way that we often make those purchases with credit, and what credit is, how we can optimize it, how we can make it work better for us. And so today, got a good friend of mine, Anthony Iacobucci, here from Uqual. How you doing, Anthony?
Good, Scott. Great seeing you. Thanks so much for the invite on.
Hey, so let's dive right in. What is credit?
Yeah, so such an important conversation that, quite frankly, a lot of people are having now, just in the state of the economy and things of that nature. You know, credit really is a depiction of your ability to pay back on specific loan products and or financing, whether it is mortgage related, whether it is an auto related, whether it's a credit card related. Your ability on a month in and month out basis to pay back on the loans. It's really an accountability and responsibility, an accountability and a responsibility kind of depiction of who you are as a potential borrower. And
how risky you are. It just all comes down to what kind of a risk that you are. Now, people start off, they get out of high school, they generally don't have any credit. How does credit actually begin?
Yeah, so it's a really, really good question, especially now we're seeing an influx of those first-time home buyers, those younger generation that's coming to fruition that want to really feel and live the dream of home ownership, but they oftentimes don't know where to start, especially in the age that we live now, the credit crunch, the availability to open lines of credit, whether it's a credit card, whether it is an auto loan, things of that nature, quite frankly, are not at the fingertips of the prospective client, coming out of college, coming out of high school. So it's imperative to understand where the specific lending algorithm, and that's really just a mathematical equation that computes the risk of your ability to pay back on that loan on a month in and month out basis.
So I remember when I was in college, and walking from one class to the next, they had these booths out there, and they were giving away T-shirts and things like that if we signed up for credit cards. So that was my first venture. It didn't go well. But yeah, people will sign up for credit cards. They're installment things on cars, on things like that.
Sure.
Even as simple as utilities. And are they paying on time on those kinds of things?
Yeah. Just to resonate your point, honestly, that was my first exposure to it. Go to my student mailbox in college and getting that shiny new credit card and 17, 18, 19 years old. I didn't know the ramifications that it would happen down the line by defaulting on that credit card, not paying it on time, letting it charge off. It was a lesson that I learned, quite frankly, 10 years later when I try to go purchase my first home. So it's very, very interesting.
And I bet you didn't even remember the things that you bought with that credit card.
You know what? In my younger days, I lived in a fraternity, so I got an idea what that card went to. It might have been beer for that weekend.
and maybe you didn't remember it. So
yeah, exactly right. But I think it's important for the younger generation, quite frankly, everyone, to understand where that credit score is coming from, how it can be controlled, how it can be utilized to give that higher credit score that's going to open the gates of great financing products, low interest rates, being approved for a mortgage, getting good terms on an auto loan. There's very simple tips and tricks that we can teach the consumer base just through like podcasts like this or having educational conversations. That's kind of been the mantra, the backbone of Uqual is we always lead with education first. Having a consumer understand where the credit score is coming from and how it can be manipulated and maximized to optimize, transactions, interest rates, terms, product lines, things of that nature.
So what are the activities that matter most? What are the detail points in calculating? Because it all comes down to a credit score.
Sure.
Is the first thing that they're going to see. Then they're going to dive in and see why is it that. But sometimes they may not even dive in if they see where your credit score is.
Yeah, right.
So what makes up the credit score?
So I'm going to just shift to the Fannie Mae, Freddie Mac FICO algorithm.
Okay.
It's specific for mortgage lending, because I know most of the folks that are listening are going to be in some sort of home process.
And I think that's kind of where people's minds are generally at too. When they think of a credit score, they're going to think of FICO.
Exactly. Yeah. So the federal government really has about 54 approved algorithms, but there's predominantly about 8 different ones that are used by the 3 main credit bureaus, TransUnion, Equifax, and Experian. And what those scores are heavily based upon is a few different factors. First and foremost is, are you utilizing debt? Whether it's, do you have credit cards open? Do you have student loans? Have you ever had an auto loan before? Really, it's kind of like, remember the SATs? I don't even know if they even take them anymore. Like signing your name, you got X amount of points. It's kind of like on the Fannie Mae, Freddie Mac FICO algorithm side. Having credit open is the first base, the first pillar that you need to overcome, right? Whether it is having a small secured credit card, getting added on as an authorized user on a parental units account, things like that. So,
not only is it starting the credit journey, but it's also starting to build those habits.
Exactly.
And if you've got somebody young that you can listen to this podcast, that's one of the biggest things is, hey, start building those habits. Get the credit, but only if you're going to use it effectively, pay it off at the end of each month, not run all these balances and build, become a victim to interest and all that kind of stuff.
Yeah, and I think it's really the new potential buyers and the old buyers where it's not really resonating properly. For example, with the younger first-time home buyers, a lot of times they don't realize, like, getting a $200 or $300 credit line and using it responsibly and properly over a 3, 4, 5 month time period, that's going to really bolster the score. There's no wealth bias in credit scoring. What I mean by that is, just because someone's got more liquidity or cash flow than you do doesn't mean they get more points. So you may, Scott, have a $3,000 credit card limit, but I may only be able to get approved for a $300 credit card limit. You're not going to get more points because you have a higher line of credit. Mm-hmm. The habits in which we formulate by using it responsibly, paying off it before the due date, and maintaining low balances month over month, that's what really increases the credit score from a revolving debt perspective. Revolving debt is just a fancy way of saying, hey, do you have a credit card? Okay.
And so having something is the first step.
Yes.
Is having some sort of a credit line. What are the other things that are considered in the credit score?
Great thing. The next point is paying things on time. It's astonishing. And again, being an educational platform, I've found that a lot of consumers don't realize the ramifications of not paying things on time. I'll get caught up in a couple months. I've got a big commission check coming back in the spring. They stop paying on accounts. When those accounts go 30, 60, 90 days late, Scott, sometimes I've seen someone lose 100 points on their credit score because they missed their auto loan payment, or they forgot about a credit card that they opened because there's really good rewards in the springtime, mm-hmm. and it converts to the summertime. Maybe it goes from a 0% product into now an APR, and they just don't pay the annual fee. Score drops 100 points. So I think, I'm paying.
And it's amazing that a lot of the conversations that we have in the current economy is, wow, interest rates are so high, and yet people are okay paying in the 20% on a credit card.
It's, the interesting thing that we found, right, I think it more correlates to specifically credit cards and auto loans, is that the consumer has to make those changes within their life to use those products. For example, mm-hmm. they have to get to work. They've got to drive the kids to school. They've got to get to church on Sunday. They can't walk around or bike around. They have to drive a car. So they're going to pay exorbitant interest rates due to having poor credit, and they're going to be driving around in a car that maybe is a $12,000, $13,000 loan, paying a $600, $700 payment because their interest rate is pushing 30%. It's just unfortunate to see people. It's almost predatory in regards to bad credit, getting affected on such products like an auto loan.
And in those cases, generally, if you do the math, you are sometimes buying 2 or more of that car
yes.
just because the finance charges versus, having healthy credit and being able to buy it at a 0 or a 1 or a 2 or 3%.
It's crazy because, again, they don't teach this stuff at high school or college. You might be sitting there and being like, I've got a 17% interest rate because my credit's marginalized. But you do that, you amortize that out on like a $20,000 auto loan, you're paying nearly $36,000 over a 60-month term, which is basically industry standard at 5 years. And it's crazy. I mean, we have a really fantastic analyzers that we not only use with you guys as a referral partner, but when a consumer's navigating this credit journey, they're actually seeing for the first time. You might see 17% and say, well, it's not that bad. Well, you're paying double what the car's value is, the sticker price in which you purchase it. It really starts resonating with our borrowers, and their eyes open up a little bit more relative to maybe just the way that they kind of just glossed over this stuff and went through their daily life.
Yeah, one of the biggest hacks to credit is just habits. And if you have credit cards and you're using them and you're paying them off, not only are you being able to do that for free because you're not having to pay interest on any of that stuff, but then that's going to give you a higher credit score. And so when it comes time to buy bigger ticket items, then you're saving thousands. And in this case, like what we're talking about, just auto loans, you're buying the same car for half of what you would have been paying for it before.
Yeah. And especially because, obviously first base of a transaction 9 times out of 10 is a credit score. But second base and third base of bringing them home, it's such things as your documentations, but having a down payment. Why don't I have a down payment? Well, you're paying $700 a month because of your marginalized credit. Your next door neighbor has the same car and he or she's paying $350 a month. That extra $3,500 a year over 5 years, that's $20,000 that you've let wash away in interest charges because your credit is marginalized and you have to get to and from work because you have to drive a car.
This video is brought to you by Klaus Team Real Estate Solutions. The Klaus Team is different. With the Klaus Team, you have someone on your side. Where you live and make memories is important. We have more unique strategies than anyone else to help you accomplish what matters most to you. We can help you with traditional real estate as well as other options such as our lease purchase programs. We can help you buy first then sell, and we can bring you instant offers. We're here to help our neighbors achieve the American dream and help them build wealth through home ownership. For more info or to start your home search, visit us online at klausteam.com. So we've got, you have to have credit. So you have to have some sort of a device, and then paying on time. What are some of the other things that are considered in that FICO?
I think another big one, quite frankly, because it's called payment history. That's where kind of all the negative information hangs out. That's where your collections are going to accumulate. Your late payments, your charge-offs or repossessions, anything that's adversely affecting your score is housed in there. And I think it's also something that's the consumer needs to understand is that a collection is a collection is a collection. Scott, what I mean by that is that a $1 collection and a $100,000 collection that report in the same month will adversely affect the score at the same rate. Too many people are like, it's only a $50 medical copay, or I didn't make my last payment at an apartment complex and I just left and moved somewhere else, or I didn't return my Comcast box for my internet or my cable. It's only a couple $100. The ramifications of just accumulating a collection, whether it's $1 or $10,000 or $100,000, is the same. The algorithm on the mortgage side does not compute monetary debt. It just picks up that derogatory trade line. So when you start accumulating collection accounts and charge-offs and late pays, it really, really attacks 35% of your credit score, which is a good chunk of your credit score.
And how long is that on there for?
Statute of limitations on most collections federally is 7 years. Collectible debt varies from state to state. Some states are 4 years, some states are 6 years, some states line up with the 7-year statute of limitations. Scott, what I mean by collectible debt is actually a creditor or debtor bringing you to court and bringing that lawsuit to the table.
So that derogatory piece could be on your credit, impacting it for years and years.
Exactly. And again, what we try to do at Uqual is really speed up that statute of limitations. We don't want a consumer to sit there, and obviously you guys on the agent referral side is we don't want a client sitting there being like, I'm dead in the water. Scott, let's have a conversation in 2030 when these collection accounts fall off. You know what I mean? Someone shouldn't have to wait 7 years to try to be like home loan ready. So with that being said, there are little tips and tricks of maximizing other areas of the credit score that we help coach and counsel at the same time as attacking some of those accounts that have accumulated at a credit bureau level.
Okay. And then we also have just the length of credit history.
Yes.
Is a piece.
Yeah. It's an important piece. Unfortunately, there's not much manipulation there. I can't make people older. My advice to maybe the listeners is that if you have a parental unit or if you have a child that has some shallow credit because they're younger, adding a consumer or adding a potential borrower on an older line of credit, they'll naturally absorb all the positive length of history that a consumer will get. For example, if I have a child that's 17 years old and I have a credit card open for 10 years, if I add he or she onto my credit card, they'll get that credit card length of history, which is 10 years, which is great. It's an interesting way we call it an authorized user, authorized signer. Most credit card companies are going to do it. Very easy way to get a quick jolt in the gold credit score if you're a younger individual. And
then the other piece is inquiries.
Sure. Yeah. Everyone's got it. It's always the hottest topic. The best way I leave it at 2 to 5 points on anything that's a hard inquiry. When I say hard inquiry, you're talking about accumulation of financing, home, auto, credit card. Anything you guys pull online is a soft inquiry. It does not adversely affect the credit score.
And just, make sure that if you are going to buy a car and you're walking in with you've already got a loan from your credit union, just let them know, please don't run my stuff. And if you do need to have them run it, just run one or two, please. Don't run them through every single bank that you know.
Yeah, especially when we have clients in our program where we understand life happens and they have to go get a car. You're stepping on a car lot. I mean, they can run you sign a blanket credit application where they're running a report 8, 10, 12 times in a day. And especially when you have a marginalized credit situation, and they're not getting the feedback on which they're looking from an approval or a rate perspective, all of a sudden those 10, 12 hits month over month, you're losing 20, 30 points sometimes just because you stepped onto a car dealer's lot. I think you hit the
nail. And that's like 2 years, isn't it? Those stay there? They
affect your score for 1 calendar year from the goal. They are on the credit report for 2 years, but the impact that you're feeling from a credit score perspective is only 1 year.
Okay, great. So what are some do's and don'ts?
Great one. I think if you are in the home buying process and you do have open collection accounts, do not touch them. The score is predicated on something called the DLA, which is the date of last activity. I've seen consumers make awful lot of mistakes by going and just start paying on outstanding debt. When I say outstanding debt, I mean collections and charge-offs, not whether it's an auto loan or a credit card, things like that. Okay, I think it's people that oftentimes make mistakes of saying, this is a $1,700 medical bill from last year, and I didn't have coverage then. Let me go pay it. Here's an old charged off credit card I had from college that's been lingering out. It's $500. Let me go pay it. Sometimes paying those collections reactivate the date of last activity, making the trade line look brand new, ultimately dropping the credit score. I think that's probably the biggest mistake that consumers make before sitting down with a mortgage professional and or agent.
Yeah, it's a complicated thing, and it's there's some things that we DIY. Yeah. And there's some things that we watch a YouTube video before we DIY, and sometimes it's just best to talk to a professional before we dive in.
Scott, unfortunately, with the age of information that we're living in, I kid you not, I have people, and again, buying a home is probably the largest purchase that you will ever make in your entire life. Why are individuals getting information or advice from TikTok or influencers or some reels on Instagram? It's crazy to me. be
No,
weird.
it's okay if they use a podcast.
Podcast is another one. When you're a bona fide expert like you are, as well as myself, it's different. But I've had people, countless people, lenders and agents alike that I've worked with the last 12 years that I've been at Uqual, NCC and Uqual, just saying, had a client, they just saw TikTok, they closed all their accounts. Or someone listened to Dave Ramsey on the radio. Dave said, don't have any open accounts. Debt is bad. It's about managing that said debt. There's nothing that's going to hurt you by having 2 or 3 credit cards that are open with a $200 or $300 credit card limit. Setting up financing for an auto loan, setting that auto loan up on auto pay, drafting from your collection account, so you're not writing a check each and every month, maybe forgetfully forgetting to pay it 1 month. So it's imperative for all your listeners to understand, do not, when it comes to credit, listen to what you're reading on the internet, on Twitter, Instagram, TikTok, whatever. Sit down with a professional and have an open and honest conversation, because that's what's going to avoid those 90, 120 days, 80 days, 180 days out where you're shooting yourself in the foot and you're losing traction on the ultimate goal of getting that home loan.
Yeah, and sometimes the things that will come up from a lender, or somebody like you, it'll be, hey, go take this card, go buy something small and pay it off, where people wouldn't think to do that, but that will help. But it's not just every single time. They know what is going to help you individually. And so diving in and having that conversation, and I would say having that conversation earlier than you think you need to have it too. It's not like, hey, my lease is up in 2 months, it's time for me to talk to a lender. No, let's have that conversation earlier, because you guys are going to be able to identify things that will help them longer, because it's not something that just takes effect and all of a sudden, 2 days later, your credit score is now down, or up because of that activity. It might take 30 days. It might take 60 days. It might take 90 days.
Tremendous points. I want to start with the latter. Absolutely. The people that are proactive, that are seeking out help, whether it's sitting down with you referring them over to us, someone getting some credit counseling and coaching before the home loan process starts, I think is vital to me. Quite frankly, I'd say about 80% of our referrals nationally, they're reactive, meaning they've met with an agent, they've met with a mortgage professional, and they found out, no, you're unable to qualify at this point. And then all of a sudden we're backtracking 60, 90, 120 days trying to get them pre-approved. Whereas if you have a savvy borrower now that's like, hey, I'm in a lease for another 6 months, I want to get all my ducks in a row. So once I am out of the lease, I'm ripping rear to go with a pre-approval in hand. Because I don't think a lot of people realize, Scott, is that your credit score it's like a fingerprint. Everyone is unique to their own. So something that might be good for you is bad for me. Something that I need to execute is something that you don't need to do. And I think people need to understand there's no generally speaking advice that you get from credit. Everybody is individual to themselves and their circumstances, their backgrounds, their payment history, things of that nature. It's important to understand that, just don't speak in generalities when it comes to credit.
Yeah. So what's different in 2023 as far as credit?
I think the ugly thing is going to be the rates. I know listen, I remember when rates were pushing 7s and 8s. My parents used to tell me stories when they were the Jimmy Carter years and then the 15s and 16s and 17s. So being in the 6s and 7s now is not that unattractive historically to where we are in the rate world.
Yeah, it used to be normative.
Yes, 100%. And I think we just live in a world of trying to keep up with the Joneses, right? 2020, 2021, where rates fell through the floor and some people were good enough to jump off the fence and get locked in at 2.75, 2.5%, 3%. I think understanding that, like, hey, that's probably not going to happen in the next couple of years, right? But
let's think about what got us there.
Yeah.
COVID.
Yeah, exactly.
And I don't think anybody wants to go through that again.
Yeah, no, absolutely not, right? And I think it's also important to understand is like buying a home is building financial security, building wealth for yourself. I know it's been a little redundant now, but it's, date the rate and marry the home, right? Where you can get into a home that you love now and you might not like the payments or the rate. At some point, they're going to come down, and having the opportunity to refinance, it's not permanent. You're not locked in at 7% for the next 30 years. You could be locked in for the next 17 months, right? Relative to the equity that you're going to gain and the appreciation that usually transpires in a healthy housing market, which it seems to still have.
Yep. So are there new regulations?
There are. So there's some things in regards to your credit score, which is going to loosen the grip that some consumers might have felt. There's really been some big changes to medical collections. About $88 billion, Scott, of medical collections at a credit bureau level. They've rolled out recently that they're going to stop holding those $500 collections or less, holding your feet to the fire from a credit score perspective. There's just a tremendous amount of ticky-tack stuff that happens in medical billing. It's a systemic problem, quite frankly, in regards to reimbursements coming from insurance providers to medical institutions going to third-party creditors to have the debt collected upon. So $500 medical bills or less should not be affecting credit scores going forward, which is a great win for the consumer.
Because it's so confusing. You'll get stuff that says this is not a bill, and then all of a sudden you realize it is a bill, and you don't know what doctors are charging. You don't know what they're charging for. It's a convoluted mess. So to be able to take that a little bit more towards the consumer is a good thing.
Yeah, it should definitely lead to a higher consumer credit score. Medical collections is the number one collection account on a consumer profile. If we're going to alleviate every collection under $500, that's a win for the consumer.
What else has changed?
Student loans. It's been a tricky one as they're caught up in federal court in regards to deferment, things like that. Just keep your eyes on that as new regulation has been rolling down. Our advice here from Uqual is that if you have the means to make payments and you have the ability to do so, make them. They're turning them into principal payments because everyone is in default right now. Everyone's in forbearance right now. So with that being said, it might be time to start engaging student loan servicers and seeing what could be done because at some point they're going to roll out after the pandemic COVID deferment process. So just keep an eye on that as well.
Yeah, and everything as far as that goes, and I'm someone that still has student loans as well. It is, I think there's a lot of people that think, oh, I heard that they're going to forgive them, so I'm going to have that. Until all that stuff happens, I would just be trucking forward and moving forward that things are as they are. And you brought up forbearance and things like that. Just understand that if you can make your student loan payment as normal anytime in your life, continue to do that, because anytime that you do a deferment or forbearance, those interest charges are being converted to principal down the road, and all of a sudden your $8,000 student loan is now $15,000, $20,000, and it gets even worse when the balances are higher than that.
Yes. Yeah. I think it's a great piece of advice. We got so many calls in 2020 and 2021 of just being like, great, well, I don't have to pay student loans. I'm like, well, do you have the means to do it? Well, yeah, I do. Then keep making that payment. It's going to be principal payment.
Because you're basically going to extend the life of that loan.
Yes.
And anytime you increase the principal, that principal is what the interest charges are going off of. And so it's just going to explode there. So you have talked about Uqual. What makes you guys different?
I think the approach. In a highly regulatory environment now that traditional credit restoration is facing, a lot of different regulation that's been rolled down on over-the-phone billing. The Uqual platform takes that concern off of a referral partner's plate and converts these clients into a fintech program that's more of a holistic approach to the home readiness process. We're not just addressing credit. There's been countless times in our 17-year history where we got a credit score, but the lender or agent or referral partner said there's no down payment. Or they said the client still has bad budgeting habits. They go late the next month. The Uqual platform helps the consumer do a couple different things. It helps them, contest the accuracy of their credit report. That's going to be that credit cleanup component.
Okay.
It's going to help them break bad spending habitudes, whether it is eliminating subscriptions, identifying where a consumer can be tighten up their belt a little bit. It's a budgeting application. And then last, we're addressing DTI for the first time, which is great. Again, we can
just debt to income.
Yeah, debt to income, right? Where it's the next really element of the credit consumer perspective, meaning like, great, I have a 640, but hey, we still have a $10,000 repossessed car in there. Attacking the DTI to making sure it fits within ratios for a lender is also the last component, which is great. And this is all encompasses on our fintech platform, where you can upload documentation that you need, whether it's a W-2, a 1099, a driver's license, bank statements, things like that. You can attack the credit bureaus on misinformation or derogatory accounts that have accumulated. And then there's a spending habiture coach and application that helps you break bad spending habits, which is fantastic, because you can upload, your bank accounts, your credit card accounts, your crypto accounts. Where is your money going on a month in and month out basis? Let's formulate a plan and help you save for that down payment. And
so earlier is better in getting in contact with you, right?
Yeah, I mean, that's tradition. Like it's got anything in life, right? Being, having a plan. Matt's got that. Being proactive and getting in touch with someone like yourself who understands the process, and getting them over to a group like us is always best practice. Because again, it's a cat and mouse, it's a song and dance with the credit bureaus. But the fintech platform, the digital integration that we have with the credit bureaus allows a lot of the heavy lifting for the consumer to be done, as long as they're following the steps and the tasks that are set forth to them, whether it's paying something on time, paying down a specific balance, opening account, closing account, debt utilization, fund allocation, things like that.
Well, thanks for sharing all that stuff. Huge amount of information. Anthony, if people want to get started, what is the best way to get a hold of you?
Anthony at Uqual.com. Uqual is short for You Qualify, so it's UQUAL.com. And then my direct is 303-500-5052.
Thank you so much. I really appreciate it.
Thanks, Scott.
Thanks for spending time with us this week at State 48 Homeowner, the ins and outs of owning an Arizona home. You can connect with us for more information, submit topics you'd like us to discuss further, and you can see relevant videos, give us feedback, answer your real estate questions, and more at state48homeowner.com.